I often get asked for options trading suggestions for people that have smaller trading accounts. So in this video, I'm going to discuss an options trading strategy that can be used by folks that don't have $100,000 in their account, or even $50,000, or even $5,000. I'm talking about people that have a micro account or even a nano account. So real quick, what do I think of when I think about smaller trading accounts? Well, I think a small trading account has about $20,000 in it. A mini account will have about $10,000. A micro account will have $5,000 and a nano account will have $1,000. Now the profitable options trading strategy that I'm going to discuss can be used by traders with $100,000 in their account, as well as traders with only $1,000 in their account. Hi, I'm Jim, and this is my Simple Option Trading channel. So when I started off buying and selling stocks and stocks options many years ago, I didn't have a six-figure trading account. I started off small and had to build my portfolio up over many years of successful trading and investing. And one of the trading strategies I use that I attribute as a key factor in my success is the call debit spread. A call debit spread is a bullish options trading strategy that involves buying a call option and then simultaneously selling a call option with a strike price that's further away but has the same expiration date for the same underlying asset. Man, that was a lot of words there, but let me break it down for you so it's easier to understand. So a call debit spread consists of two separate parts. Now, in part number one, you're going to buy a call option. And as with all options, there's going to be a strike price and an expiration date. Now, for part number two, you're going to sell a call option in that same transaction, except this time it's going to have a higher strike price, but the same expiration date. So to help you better understand this transaction, the call debit spread, let me walk you through an example on my computer and you can see how I actually set this up. So for example, if I'm looking to execute a call debit spread for Redwood Trust, stock symbol RWT, I would first take a look at the stock. Next, I would press Trade RWT Options. Now let's say I go 1 month out, so let's pick May 20th as my expiration. And so for part one, I'm going to be buying a call with a May 20th expiration, and let's use the $10 strike price. So I'm going to click the plus sign here. And then simultaneously for this transaction, I want to sell a call option with the same expiration date, but now a strike price that's further out. So in this case, let's use the $12.50 strike price, and I'll say sell. And now you can see on my screen, this transaction has been identified as a call debit spread, which is perfect. So this is a quick way of verifying that I've got the configuration set correctly, where I'm buying this $10 call option and paying 25 cents per share. Simultaneously, I'm selling the $12.50 call option and I'm getting paid 1 cent per share. So my net cost will be 24 cents per share, or a total of $24. Now what's really nice is you can take a look at the maximum loss and profit down below. So you can see my maximum loss is going to be $23. Roughly that's what I paid, right, for the debit spread, $24. But my maximum profit is going to be $227. And from the graph, you can see how this will work out. So the current share price is $9.72. So you can see I'm in the red. So even if the stock price goes lower, my maximum loss still stays the same. So the most I'm going to lose on this transaction would be $23. Now my break-even cost is if the share price goes up to $10.13. At which point, the amount of money that I paid for the debit spread will equal the amount of profit I can make from it. So I'll be breaking even. Now if the share price continues higher and actually reaches the strike price of $12.50, now I have an opportunity to maximize my profit. And anything above the $12.50 strike price, my maximum profit is still capped. So that was a quick, simple example of a call debit spread. So you saw in part one where I bought a call option that had a strike price and an expiration date. And then in part two, I sold a call option, but this time it had a higher strike price, but the same expiration date. I wonder how many of you were paying attention and saw what happened there. Now I recorded this example during the live market hours, and if you paid attention, you saw something unusual happen. Okay, so maybe it's not that unusual, but you get to see what happens and the dynamics involved while recording during a live market hours. So as I zoom in, you can actually see the premium payments actually change while I'm making this recording. And so the profit and loss actually changes during this session. So I had initially thought that my maximum loss would be about $23 and the maximum profit $227. So in this case, the maximum profit would be 9.8 times greater than my maximum loss potential. And then as I'm recording, the premium prices changed such that my maximum loss would now be $18 and my maximum profit would be $235. So in other words, my maximum profit would be 13 times greater than my maximum loss. So in just a few minutes, my maximum profit potential went from being able to 10 times my money to being able to 13 times my money. So now, with just $18 in my trading account, not $100,000, not $10,000, not even $5,000 or $1,000, but just risking $18, I have the potential to earn 10 times more than the amount I'm risking. Hey, well, it's one thing to talk about it, but it's another thing to actually do it. So let me share with you a live session that I held with my Simple Trading Room Discord community. Now, if you're not a member yet, you can still join. Just head on over to discord.simpleoptiontrading.com. And as a member, you'll get access to my stock picks, my trade alert notifications, plus you'll be able to join these live streaming sessions where I'm interactive and able to show you my trades in real time and you can ask me questions. So during this particular live session, I call out my stock pick for Knight Swift Transportation Holdings Incorporated, stock symbol KNX. I run through the fundamentals and a technical chart analysis before revealing my option play. So now let's join the replay of this live session where I've revealed the stock and the option play, the call debit spread. Members with a smaller trading account could actually get in on this trade. And so I'm looking at doing a call debit spread. So I'm going to be looking at, well, let me just go over to my Robinhood account. Let's take a look at the stock itself. Here it's trading right now at $45.53. And what I want to do is a call debit spread. And that involves actually buying a call at one price. Let's say I could do this one, the $50 strike price, and then selling the call with a higher strike price. Same expiration date, but with a higher strike price. Hey, sorry for the interruption. I needed to pause the video. I just wanted to explain real quickly that in my Simple Trading Room Discord community, we talk about picking the two different strike prices for the call debit spread. So be sure you join so you can get in on that conversation. And you can see here, it's Robinhood immediately recognizes this condition as a call debit spread. So you buy at the lower price you buy with the strike price at the lower you buy with the lower strike price, and then you sell at the higher strike price. And the idea here is that well, you can see the Robinhood automatically calculates the profit and loss. And so in this situation, if I were to execute this particular spread here, you can see that my break even is at $50.03. And so I'm neither winning or losing any money at this point. Now this trade cost, it's going to cost me $7 because I'm actually buying. So I'll be buying this this option. I'll pay $8 or 8 cents per share, or a total of $8. But simultaneously, I'm selling a call option with the $55 strike price, and so I'll be receiving $1 back, and so my net is 7 cents per share, or $7. You can see that here. So here's the $50 call where I'm buying and I'm paying 8 cents per share, and then I'm selling the $55 call and receiving 1 cent, and so that difference is 7 cents per share. Here's my expected profit and loss. Here's where you can see this. There's a faint gray line right here. If I move my arrow cursor over, you can see it. That's the current market price at $45.54. If the stock price hits $50 currently right now, that's my break even. And so I'm either winning or losing. And the max I could lose is $3. And so it doesn't matter where I go on this line. The maximum I could lose is $3. And the maximum gain, or the max profit, is realized if the stock hits $55 or higher. So that's my $50 strike price or higher. I would stand to gain $497. So I'm risking $3 because that's my max loss. But the potential is if the stock goes up to $55, I could potentially earn $497. So here's the actual transaction record from my account history where I was able to actually execute this call debit spread. Now, because of the difference between the time I recorded it and I was actually able to execute this trade, you'll notice that the numbers have changed radically, just as they did in the example before. But I still think it's a good trade, so I went ahead and executed anyways. So far, after 1 week, just 7 days, I'm up $20 on this trade. Now, $20 isn't a lot of money. That's a 40% return on my investment. Now, that's not life-changing money, but when you think about it, how many 1-week investments do you have where you get a 40% return? And now, here's one more thing that I want to share with you. We talk about how to pick the two different strike prices. We talk about how to pick the two different strike prices for the call. We talk about picking the two different strike. We talk about